What a wild week on Wall Street. A single tweet from Roaring Kitty, the Reddit account that really launched the GameStop craze that made its way to AMC and all other kinds of parts of the market, came back to life on Monday, and that really sent a ton of stocks going crazy. And what a lot of these investors are doing and what traders are doing is targeting stocks with large short interests. And what they're looking for is a short squeeze. So what in the world is a short squeeze and why should you care about it? This is one of those dynamics in the market that every investor should at least understand at a basic level, because this is something that happens periodically. It can work to your benefit. It can work to your detriment, but understanding the dynamics behind it is really important. So that's what I'm going to dig into today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So first of all, let's define what short selling is. Short selling in its simplest definition is betting against a stock. You're betting that a stock is going to go down in value. But how do you actually do that? Because if you're selling a stock to somebody else to bet against it in order to buy it back later at a lower price, you can't just magically do that in the market. So what you need to do is actually borrow those shares from somebody else. So here are a few of the keys to short selling. What short sellers do is they borrow a security and then sell it on the open market, planning to repurchase that security in the future for less money. That's the plan. There are a couple of risks that are involved in that. Depending on the security, you may actually have to pay money to borrow that stock from somebody else. So if it's a big stock, not a big short interest in the stock, probably going to be very, very low cost or free to be able to short that stock. But if it's a stock that's very highly shorted, meaning it's very hard to find shares to borrow, then it's going to be very expensive to short that stock. It might be 20%, 50% on an annualized basis to borrow shares. So that can be very expensive. You need to have a very high rate of return on that stock, on that short position, to be able to cover those borrowing costs. Now, one of the interesting things is, as an investor, if you are long a stock, you can actually choose to allow your brokerage company to borrow stock for you, and you can generate a return on that. You may not want to do that because you may not want to see your stock shorted, but this can also be a way to make a little bit of extra yield on the stocks that you own. Robinhood, for example, allows that as just one of the settings in their brokerage account. But that's the mechanics behind it. But those mechanics are important when you get to something like a short squeeze. So what is a short squeeze? A short squeeze is when the value of a stock rises and it ultimately forces the people who are short the stock to buy it back at a higher price. And the more they buy that stock back, that actually fuels the stock moving even higher, which squeezes other short positions because these losses are accumulating. And a short position is not something that you can just hold indefinitely. You actually have to have the money to be able to buy that stock back. Remember, when you buy a stock, if you buy $100 worth of stock, the worst thing that can happen is you lose your $100. If you short a stock for $100 and that stock goes up, your losses are potentially infinite. Your losses are not capped in a short position. So if that stock goes from $100 to $1,000, you've now made a $100 bet and lost $900 on it. You sold the stock short at $100, bought it back at $1,000. That's the risk of short selling. And that's what happens when there's a short squeeze. When you see these stocks move up dramatically, it ultimately could end with a brokerage just saying, we're going to close out this position for you. Or if it's something like a hedge fund, they're going to manage their risk and say, hey, how in the world do we back ourselves out of this position? Do we start to use options to take risk off the table? Do we actually close some of the position? But the effect of the short squeeze and what you actually see in the market is there is a dramatic move higher in the stock. And that's what we actually saw this week in a number of stocks. A number of highly shorted stocks saw significant short squeezes. So I want to go through a couple of those to just give some examples. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. This is from Market Watch, and this is an analysis of the companies that have the most of their float shorted. Float are the shares that are traded freely in the market. So basically the number of shares that you could go out and buy as an individual investor. Percent, and then you compare that to the short interest in the stock. That's how you get the float shorted. Now, SunPower, which is at the top of this list here, is partially owned by Total Energies. Their shares are not part of that float because they're not trading those on a regular basis. So that's why the total shares outstanding and the float can be a little bit different. But what you're seeing here is the companies that had huge moves this week because just that single tweet from Roaring Kitty brought out the thesis of, hey, maybe we're going to go after highly shorted stocks and try to squeeze those stocks again. That's what happened with GameStop. That's what happened with AMC in 2021. So what happened to these stocks? Let's go through a couple of them. SunPower. Now, I'm recording this after the market closed on Wednesday, but you can see shares closed last week at about $2.30 per share. There was a move higher on Monday, but they shot higher on Tuesday when the thought was there was going to be a huge targeting of short sellers in the market. So that's exactly what happened on Tuesday. Shares were up over 100% at one point. Something similar happened at Micro Cloud Hologram. B. Riley Financial was on that list. It's about $1 billion market cap company. Similar move on the 13th. Maxion, which is actually the spinoff from SunPower, so both of these companies were highly shorted, saw a similar move. Big jump on Tuesday after closing last week at about $2.21 per share. Now, the ultimate move has not been all that big, but you can see that some of these highly shorted stocks had huge moves in the market, specifically on Tuesday, gave some of that back on Wednesday because it doesn't seem like the short squeeze has really caught on with investors. But this is the dynamic that's going on. This is how you can get a 100% move in a company that has zero news coming out. So are short squeezes the kind of things that you should be looking for or worrying about as investors? The simple answer for retail investors is no. This is often a game that's played among hedge funds. So hedge funds that will take a short position in one stock, if another hedge fund finds that they're in a little bit of financial trouble, they'll try to short squeeze them out of that stock. It's a game of big money. What made it work in the GameStop era was that there was thousands and thousands of retailer investors who were basically playing the exact same game that Wall Street hedge funds do. But you have no idea when this is going to happen, if there's going to be a short squeeze at all. Maybe the short sellers are right about their thesis. SunPower has been a company that has been down all year, and the short interest has actually increased as the stock has gone down. You also have no clue what the other positions they have. Maybe they're covered by options. Maybe these are short positions on debt. A lot of times, companies that own the debt of certain companies will actually take a short position because they don't want to be long or short the stock. They just want the yield that they're getting from their debt. So there's a lot of dynamics that go into this. And the other thing that I want investors to keep in mind is that short selling is part of a healthy market. If you can't bet against stocks, it means that the only way to make money on stocks is when they go up. And that's how you get disjointed markets like you have in China, where you can't short sell, where you get asset bubbles that just end up in collapse because there's no incentive for anyone to take the other side of your trade. So short sellers aren't popular, especially here on YouTube, but they are part of a healthy market. And if you are confident that a stock is going to do well, that a company is going to do well, and it happens to be a highly shorted stock, that can actually be a great time to buy a stock. So don't be afraid of being in stocks that have high short positions, because if you're correct and your analysis is correct that the business is going to get better, that the market's opinion is going to turn around, that will actually provide fuel for that stock going higher as those short sellers have to buy back the stock. But understanding the dynamics of how short selling works, why it's a part of a healthy market, and what a short squeeze is something that every investor should do. So hopefully this was helpful along that path. If you have any questions or comments, leave those in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.